Alright, in this video we're going to look at Dupont Analysis for Whirlpool and Whole Foods markets. And Dupont Analysis breaks down the return on equity into three component pieces. And those component pieces are sales profitability, how much you earn per dollar of sales, times asset efficiency, the efficiency at which you employ assets to generate those sales, and financial leverage, how much of the assets are funded using other people's money or liabilities. If you can borrow money at 3% interest and then purchase assets that earn 10% with them, the more financial leverage that you use, the greater your return, because you're borrowing at 3 and investing at 10. The downside of that is it makes it riskier. So financial leverage is the equivalent of taking all the equity out of your home by taking a second mortgage. It gives you some money to play with, but it also increases the risk of default. All right, we measure sales profitability using the net profit margin, which is net income over sales. And if you multiply net income over sales times sales over assets, notice that sales is going to drop out of both of these, and what you're actually going to have is net income over assets, which is basically giving you net income over assets, or the return on assets. All right, so now you have net income divided by assets. That's ROA. All right, so that's a measure of how much you earn on the assets you use to run the business. If you took the net income over assets times the assets over equity, notice that assets, the denominator here, is canceled out by assets here, and now what's left over is net income over equity. So what you're actually doing with Dupont Analysis is figuring out where the net income over equity, the net income earned by the shareholders, where it came from, is how profitable the sales are, how efficient you are at generating the sales, and how much financial leverage or other people's money is used to leverage up these returns on assets. When we're making comparisons between companies, we want to look at the components, all right, how they got to where they got, but we also want to look for changes over time to see how that impacts the return on equity. So if we start looking at net profit margin, ignoring 2012 as an aberrant year, you can see that it's roughly 4% on average for the 4 years that we look at, 2013 through 16. So while there's normal up and down in given years, we're looking at Whirlpool about 4% on average. We see Whole Foods was 4%. It's dropped to about 3% in the last couple of years. So while we see stable to increasing for Whirlpool, we actually see some decrease in the last 2 years for Whole Foods in the sales profitability. However, Whole Foods made that up by becoming more efficient. 2.2, 2.3, 2.5, 2.7, 2.5. So the sales efficiency has gotten higher, and what that means is that the total return on assets more or less stable in here for Whole Foods, and also twice as high as it is for Whirlpool. So they're similar in terms of the average profitability, but the total asset turnover, sales per assets for Whirlpool, is close to 1-to-1, $1 sales for every $1 assets, and it's 2.5 over here at Whole Foods. So they generate a lot of sales with relatively fewer dollars of assets. When we get down here into the financial leverage, remember the debt ratio, if you watch the other video, the debt ratio for Whirlpool is about 75%, which means that the assets are funded 75% debt, 25% equity. Well, that's what the equity multiplier is telling us. It's $4 of assets for every $1 of equity. So if the $4 of assets are funded with $1 equity, the other $3 must be liabilities. And notice the difference in the leverage. Now, Whole Foods increased its financial leverage materially, especially through purchasing or issuing long-term debt in the later years. So they went from roughly 33% of assets funded with liabilities to 50%. And a debt ratio of 50% gives you an equity multiplier of roughly 2. So you can see how they had a higher ROA in 2012, but the low equity multiplier left them short on the return on equity. They have used financial leverage to take a lower profit margin, higher total asset turnover, and higher equity multiplier to leverage up their return on equity a little bit. So it's a different mix in here. You can follow the trends in Whole Foods. And you can also see that it's a different approach. Profitability is the same for these two firms, but the asset efficiency is much higher for Whole Foods than it is for Whirlpool. However, Whirlpool has twice as much financial leverage, which gets them to a higher return on equity point than Whole Foods. So we use Dupont Analysis to see how the firms got to return on equity.